So, how to fund your business? Does this look like either of your piggy banks? Just trying to tape it and hold it all together, right? And you know, if you put something in the top of it, it may come out the side or the bottom. Don't even know if that little hole in the bottom is covered up or not, right? So when it comes to doing contracting, you're going to have some funds, and they're going to have to come from somewhere. I mean, again, if you can go to the bank, please do. But if you need an alternative, that's what we're about to talk about. So you're going to need funds to start your contract, purchase materials, supplies, take care of payroll, may need insurance, may need to buy equipment, may need some bonding. You have a lot of needs. So what are some of your alternatives? You can go to the bank, and again, we talked about that. Credit cards, I mean, it's nice to have credit cards, but you don't want that to be your primary funding option. Personal loans. When you start looking at personal loans, of course, you got to have strong credit, all right? And all of these are good options if you qualify for them. Then there's factoring and invoice receiving. Anyone know what that is?
Yes.
What's factoring? Who said yes?
The invoice receiving is when you go to someone and use your receivable to get the cash.
Have you ever done that?
No, me personally, no.
Okay. And that's a good description. Basically, once you do some work, you can cut an invoice. There are financing companies out there who will buy that invoice from you. They'll advance you a certain amount of it, maybe 85, 80, 90% of the invoice. They'll collect the rest of the funds from your client and then take a certain percentage off the top. All right? So that's typically how factoring works. Anyone have a rich friend or uncle? I mean, that's why we're going to Uncle Sam, right? We're trying to get our piece of it, right? All right, and then there's hard money. Anybody know anything about hard money?
It's hard to get.
It's hard to pay back.
Well, they call it hard money because it's really expensive, and I mean, you got, and then it's secured by personal assets or hard assets, typically real estate or your home or a second home or something. But whatever it is, you know, is something they can take if you can't pay them back. All right. So when you go for hard money, you're putting some asset at risk. Okay. So there's alternative financing out there, and there's the Mobilization Fund, which we offer, and I'll talk a little bit more about that later. Meeting financial challenges. There's financial literacy trainings. These are things you need to ensure. First of all, learn all you can about your financing. I mean, I've talked to a lot of business owners. You ask them about their numbers. I don't know. You got to ask my accountant. Really? I mean, how much money did you make last year? I don't know. You got to ask my accountant. Well, how much money are you burning on a monthly basis? I don't know. You got to ask my accountant. Well, what do you know about your business? And don't you think the numbers are important? All right? I mean, it's going to be real important for you to know your own numbers, especially in this business when you go to bid on something. You go to bid on a project and you don't know your numbers. How do you know if you're going to make money on that project? Right? All right. So always important, startup funding, equipment funding, operating capital, contract funding, expansion capital. There are companies out there that specialize in all of these particular aspects, and they're not necessarily banks. Okay? Alternative financing, these are some various types of it. We talked about the factoring, which is the first option. Equipment leasing. Equipment leasing is a $500 billion industry. Do you know what equipment leasing is?
When somebody needs a Bobcat,
Okay.
you can lease it instead of trying to buy it or something, or, I mean, even down to just necessary tools you need on a construction job, you can lease them.
Exactly. Now, are we talking about like a car lease?
No,
What's the difference?
between a car lease and an equipment lease?
Yes.
Okay, first of all, the terms.
Okay.
Time?
Well, there are a few different things. An equipment lease is installed in mind with you owning the equipment at the end of the lease.
Oh, okay.
All right?
Okay.
That's the primary difference. It's
Okay.
really just a way of financing a piece of equipment. They call it a lease, but it doesn't require a huge down payment. You know, if you were to calculate an interest rate based upon it, it'll probably be a little bit more. But you can find low rate equipment leases just like you can find low rate mortgages. You just have to have what? You have to have better qualifications. So typically you're paying 2 months payments in advance, maybe some fees or something like that. And at the end of it, you have dollar buyout leases, you have $100 buyout leases. You have leases that are structured to buy out at market value of the property at the end of the term. 36 months, 24 months, 60 months. Question?
Well, I've heard of that, but I didn't realize that at the end of the lease that you were, it's like a car. I see what you're saying, that's why I was asking what's the difference. Because you have the option to either buy it or give it back, but it sounds like you're saying you would most likely buy it.
Yes, most likely buy it. And let's say you were to go out and buy that piece of equipment, or get a loan to buy a piece of equipment. Equipment leasing has favorable tax terms. You can write the whole payment off, not just the interest from a tax perspective.
But at the end,
You're
buying it.
You're buying it throughout. Okay. It's just that the title for the piece of equipment doesn't transfer until the end.
Just like a finance.
It's a fine, so you're not, okay.
Yeah. But at the end, dollar buyout, $100 buyout. I mean, it's not like a car where they really want it back.
I mean, when you put it for a lease, it sounds just like a loan. But is it like cheaper to do it that way because there's an interest rate, or do they mark up that?
Well, typically when you go to get a loan, they're going to ask for a huge down payment. And we'll go into it a little bit later. I mean, I can't go through all the details on all of these, but, if you have some specific questions, I can address those, okay? There are business loans. There are several types. We'll touch on some of them. There's trade financing. In trade financing, we're talking like purchase order financing, and you may not know what that is, right? Okay, trade financing, if you need to buy some inventory or something, if you need to fulfill an order, someone gave you an order and you don't have the money to deliver on that order, you can go to places and get the money to deliver on an order because you have a client willing to pay for it. All right? So in cases like that, just with anything, if you're doing business, you got to know what it costs to do your business, right? Know what your financing is going to cost, and you can build that into your profit margin. All right? You guys probably know more about bonding than anything else here. Church financing, that's just something I can offer that we don't need to talk about
Can I
here.
ask a question about it?
Yeah.
How does it work if a contractor is pursuing bonding but has had a personal and business bankruptcy that has been discharged?
It's going to be tough.
Yeah.
It's going to be tough. You're going to have to start out small. There are some bonding
Like
companies.
fast track, I mean, what, 250,000, 3, 5, what are you How small?
You're going to be starting small, probably 50,000 just to
Oh,
get
wow.
started.
Okay.
I mean, you're going to have to build up some capability.
Okay.
And there are some bonding companies out there that are a little more less restrictive when it comes to qualifications. But when they see things like bankruptcy
Is there
and
anything that can assist in expediting it? Like,
well, the SBA has some programs, but I don't know if they address bankruptcies. I mean, they're more geared towards startups and smaller companies. I don't know about bankruptcies. But, I mean, as with anything, I know with financing, I talked to a lot of different financiers over the weekend, or this past week, and they were like, we don't mind someone who has issues in their past and they come to us and they're upfront about them. And they're like, okay, we can deal with that. That's someone who's had a few things, they had a story, they told us their story up front. Now we know what we can deal with. But if they came to us and said, oh, it's all good, filled out the application and then they start doing the due diligence and they find the problems, at that point, there's nothing you can tell them. I mean, it's all about, what they're trying to do is assess your character.
okay.
And if they get to the point and they don't trust you, I mean, any bad performance you may have had, it's just going to carry forward. So, be honest, be upfront, and that's always going to be your best option. Okay? So we're not going to go through the details of factoring, but basically factoring, you have an invoice. So that means you've completed some work, all right? That's the key part. You've completed some work. You can cut an invoice to someone, and as opposed to waiting on that client to pay you on whatever net 30 days, net 45, or however long it takes them to pay you, you can get an advance on that invoice. All right. It helps when you're looking to expand operations or you just need to make some expenditures, pay for some expenses on whatever project you have going on. A lot of different companies use factoring. Factoring is actually a $2 billion business in the U.S. I just came from a conference where there were close to 1,000 people there, and most of them doing factoring, small factoring, large factoring. With the creation of the UCC code, an invoice becomes transferable. It's just like money. It can be used as collateral for different things.
Now, with factoring, is it like, if you doing a $25,000 invoice as opposed to $5,000, do you get like better interest rates, or is it just, or it depends on the company?
It really depends on the company.
Okay.
When it comes to factoring, the size of the invoice matters because some factoring companies won't touch you unless you're doing more than 50,000. And like I said, there are some smaller factoring companies that will do a $5,000 invoice, and they'll charge similar rates to the 25,000. But that's just the level of risk they're willing to take, because there's a lot of fraud in this industry too.
I was just gonna say, how do they follow or verify it?
They have to talk. They have to talk to your end client to verify the invoice, and they'll do that. And once they may not do it so much once they develop a rapport with you and with the client, but they want to make sure that they're going to get paid. There are some horror stories out there about the fraud that goes on, though. I mean, the stories I heard just this past week are just crazy. So there is a lot of due diligence that they will do on you and your end client. But the preponderance of due diligence is on the end client, because they have to be able to pay. All right. Equipment leasing, again, is a $500,000, $600 billion industry. And we talked about a little bit about how it works. Again, designed for the client to own the equipment at the end of the lease. And the lender keeps the title of the equipment and has filings against the equipment until you pay it off. Why lease versus loan? So this is some key important points. With a lease, there's no down payment. You basically pay your first and last month's payment. All right. On a loan, of course, you know you're going to have a down payment. With the lease, there are no blanket liens. Anybody know what a blanket lien is? All right. If you go to a bank and you get a loan, they're going to put a lien on all the assets of the company, so that if you don't make payments on that loan, they can come and seize equipment the company owns, or they can take over receivables or bank accounts. They're gonna find whatever they have to make sure that they're made whole. All right, so that's what allows them to do that, the blanket lien on the company. There are no financial covenants with the lease. What financial covenants do is they restrict you from doing, say, getting additional loans or something like that. You have to keep a certain amount of money in the bank or something like that. Whatever the bank feels they need to put in place to limit their risk on not recouping the funds that they're giving you. All right, payments are tax deductible. I talked about that. And does not affect available credit. This is a form of off-balance sheet financing, right? So it always helps. You qualify for more financing this way. I'll put it that way. Let's see, only partial tax deduction on the loan side. Those are the key points here. Moving on, equipment you can fund. I mean, the industry is huge. Anyone who needs a piece of equipment, from restaurants to hospitals to construction companies, you know, it's really all over the place. You can do an equipment lease on office furniture. All right. Unsecured business lines of credit. This is an option that's really is quite restrictive in that you have to have really good credit.
I got a question.
Yes.
You said that leasing is a form of off-balance sheet financing.
Yes.
In what way? I mean, because the assets are going to be listed on the balance sheet, are they not?
The assets may be listed on the balance sheet, but if you were to, the assets definitely would be on the balance sheet. Yes?
When you say off-balance sheet, you're talking about, yes, the asset will be on your balance sheet because you have to show that
Right.
there. But aren't you really saying that it's not going to affect your bottom line as far as your credit is concerned, that when somebody pulls your credit, they'll see this as a line item on your credit?
Is that,
It won't show up on their credit.
oh, okay.
It'll show up on your balance sheet.
Okay.
Okay, off books. Sorry. All right. So here, with an unsecured business line of credit, you're talking about someone just giving you money, no collateral. You know, they haven't reviewed your bank statements or anything like this. There are programs out there where if you have just really good credit, you can qualify for $25,000 on up, starting with just maybe a 720 FICO score. So what they're using is your personal credit to qualify you for business credit. All right? So they're saying, well, they've managed their personal credit well enough, we're willing to take the risk. All right? And there are banks that do that. There are specialty companies that do that. And what else am I going to say about that? If you qualify for the business line of credit, it doesn't show up on your personal credit report. so it doesn't impact anything you're doing on a personal level. You can go apply for mortgages, have this $25,000 for your business, and you know that's the good thing about business credit versus personal credit. Keep things separate as much as you can. All right. Potential uses for startup, business acquisition, business expansion. You can use the funds for whatever you need them for. Business loans. There are several types of business loans. Let me see, do I go into? No, I guess I'll describe them both here. Go
I
on.
had a quick question.
Sure.
So if they just give you, say like a business credit card or whatever, but don't you have I mean, if you wanna go for another bank loan, like, let's say you just got a small credit, like a $2,000 one, but you need a larger loan, would that show up? That doesn't show up anywhere?
It depends on if it's business or
No,
personal.
it's business.
If it's business, it won't show up on your credit report. It reports to the business.
That's what I mean. So
The only thing that may show up on your personal credit is an inquiry.
Oh, okay, so if you go for another business loan, then that small, like, little line of credit would show up anywhere?
No, it wouldn't show up. It would show up on the business, because at that point they can pull D&B.
Yeah, okay, that's what I mean.
Yeah,
It's like, okay, that's what I meant.
yeah. All right, so it would get reported to the business, but not to your personal.
Yeah.
Okay.
How do you create lines of credit or credit lines that show up on your D&B?
There are different ways to do that, and we can go through some of that a little bit later. I may have to include that in this presentation, but I'll talk to you a little bit about that. With this program, if you were to go through this program, at least the one I'm most familiar with, it creates your D&B entry.
Profile, okay.
Yeah, it starts that profile. But there are several things you can do to create that D&B entry just by obtaining credit in the name of your business. You can get trade lines at, say, an Office Depot or someplace like that, and that'll create some entries for you too. All right. If you've got a small business and you just want to create that, I recommend going to get those started. You know, get a trade line or two, and get some positive reporting going. Not only will that help you get some other.
You mean Office Depot or Staples or something?
Yeah.
Yeah.
Okay,
Yeah,
just those two.
there are more. Depends on your business, you know, and what you need. Home Depot, Lowe's, you know.
You saying you go get a credit card from those businesses?
You can get them from the banks too.
Yeah. Well, you can get the credit cards. The trade lines have to come from a vendor.
Oh, yeah, with the credit card.
Yeah, yeah. But the thing is, make sure it's business credit versus personal. All right? Make sure you're using your EIN and your company name. And that goes a long way, even if later you have to go to a bank, because they have something to refer to. They can see how you've handled your credit. You know, they can see what type of payments. They can see that you've been able to, you know, make payments and everything. All right, moving on. I think I'm running out of time here, and I want to get to a few things. That trade financing, we talked a little bit about that. Involves purchase order financing, letters of credit. Basically, say you're doing business with someone overseas and you want to make a purchase. Are you going to send them money without even knowing what the product looks like or anything? That intermediaries come into play here to establish letters of credit. They'll inspect it, and they'll only pay the fines once the order meets your qualifications. And purchase order financing can work the same way. Somewhere with it, you know. If you're obtaining some funds and it's going to cost you 10% or it's going to cost you 5%, whatever you're using that money for needs to generate more revenue than it's going to cost you. right?
Right.
Okay, otherwise,
It's a
you're,
waste.
you're digging a hole for yourself, basically. So, just to bring that point home, here's a little illustration. Say a contractor borrows $100,000 to start a contract that was going to earn him $1 million in the first year with 4 option years. All right, he has to take care of insurance and payroll for 4 months and, just the normal expenditures of this contract. Let's say you have to pay back $200,000 using contract proceeds over the first 4 months. So that's basically like 100% interest, right? First of all, would you do it? Would you take that 100,000
Probably not.
and knowing you have to pay back 200,000?
If I'm gonna make $1 million?
You're not gonna make a
You're
million,
not gonna
that's
make
the,
a million.
that's the
Wait,
face of
wait.
the contract.
Why
How do you
say
know
you're
that?
not-
Well,
How you know that?
This is a contract that
What
was
do you
going to
mean?
earn.
Oh,
Yeah.
so he's gonna earn, or is that the
It
contract?
says earn, that means he's gonna get that.
That's it.
Oh, so he's
He
gonna
gonna make
earn?
money in
Yeah.
change.
All right, well,
Come out, okay.
Yeah.
Yeah, I was confused.
So, I mean,
You might know.
turn your mic on.
You turn your mic off.
we're good? All right. Okay, so,
Okay, earn.
so he's gonna earn $1 million on this contract in just the first year.
Oh, well then, yeah, that's different. Okay.
Okay. I mean, how much would you be willing to borrow? How much would you be willing to pay back?
200,000, 300,000.
So this is an example, I think it's an example of good debt. Maybe you'd prefer better terms, but hey, if you had other options, you wouldn't do this one, right?
Exactly.
Contract, yeah.
Okay, so, all right, you guys are on board with me then. All right, so commercial bank loans, we know what they are. Hard to qualify for, but they're short-term, medium-term, long-term, for real estate, so on and so forth. Let me.
It's like a go out and get yourself to go on.
All right. So asset-based lenders provide a variety of financial services, and typically what they'll do is they'll charge higher rates for a little less restrictive qualifications. Okay? If you meet the qualifications that they're requiring for that money, you can get the money. You may have to pay a little bit higher rate. Some of them require security. Like hard money, they require hard assets. They're going to do it for real estate. Some of them require receivables. If you've done some work and you have an invoice, you have a receivable. And like I said, the UCC code specifies that you can use that as collateral. You can get advances on those receivables. Same for machinery and the equipment. They'll take different types of collateral for the money that they're going to give you. So, the way we see it, government contractors need a better solution because, they may not say you have a contract and you need to get started. What do you have as collateral? So, was that? Did you say you're going to smile at somebody? Bat your eyes? What?
She said, her.
Her! Oh! I didn't know.
That might be something to do in New Orleans.
Hey, what you trying to say about my hometown?
That's where they from.
That's where I'm from.
Yeah, they was from there first.
Okay. So, we do have a customized solution for the government contractor. It's based on a mobilization fund, and what it does is it accepts the fact that the government is a good payer, right? And we know that if you perform the work, we'll get paid back, you'll get paid, right? So the funds are used to help you get started on a contract. It's alternative financing. It specializes, more flexible from an underwriting perspective. The emphasis is put on the fact that it's the government and it's an invoice or actually we're helping you before you can create an invoice, right? So we're looking to develop a relationship with you so we know who you are and come to understand how you perform on your contracts, that you can do the work. And, again, it's short-term financing because the intention is to help you stand up on your own, not for us to be your crutch. Okay? So we'll help you in the beginning of a contract through the first 3-4 months of the contract. At that point, we think the invoice payments should be able to hold you up. It's customized for the needs of the government contractor. It's like early stage financing. Actually, it's like purchase order financing for a government contractor. Again, provides funding before service begins. If you could provide the service, you wouldn't need us because once you have an invoice, you can go and factor it, right? Okay? In fact, if for larger dollar amounts, we can work in conjunction with a factor to take us out on the back end. All right? It'll be for government contracts, not for any commercial contracts or anything like that. All right?
Contracts only.
Government contracts only. All right? Loans available from $10,000 to $2 million. So minimum 10,000. Funds can be used for contract-related expenditures, make payroll, obtain insurance, purchase materials, buy supplies, pay vendors, pay subcontractors, purchase equipment, anything related to a contract. All right? Non-project expenses, what do you think? Not covered. Not covered. So what we're trying to do is make sure that you can perform on this contract. So we're not looking to pay your mortgage. We're not looking to pay for your Jaguar or anything like that. No, I'm not paying for your Jaguar. I'm sorry. Hey, you can bat your eyes and smile. But typically what we'll do is sit down before the contract begins and lay out a schedule of expenditures associated with that contract. And we will pay those expenditures as they come up. If it's payroll and it's time to pay for payroll, we'll take care of that payment to your payroll provider, you know. If you need a piece of equipment to work on the contract, we'll work with you to get that. And we can either do it via lease or, we'll work with the vendor or whoever it is to facilitate getting that piece of equipment in place for you to work that contract. And again, I've been a commercial finance broker for the last 6 years. So I have a lot of other different options available should you need them, if you need funding beyond the scope of a mobilization loan. How to qualify. Let's just skip over that because we'll cover it better later. How long to get funding? Funding can be as quick as 1 to 3 business days for those who have been pre-qualified. So we suggest that you get pre-qualified. Pre-qualification doesn't require a contract, but it allows us to do our due diligence on your company in preparation for you to get that contract. Once you get the contract, we evaluate the terms of the contract, the payment scope, who you're doing business with, so on and so forth, and we lay out the rest of the schedule, the payment side of the schedule. Okay? Again, loans from 10 to 2 million, in general, up to 20% of the yearly contract value. This is the percentage of a contract that I think can be paid back in a short period of time. Again, if you have needs outside of that, we can help with that too. The structure of the contract payments will factor heavily into how much can be borrowed. I mean, if the contract is front-loaded, you may be able to borrow more. If the contract has most of the payments on the back end, you may not be able to borrow as much. So it just depends. Mobilization is a short-term deal to help you get established. The rates vary based upon the strength of the company and your ability to fulfill the contract, who the customer is, and so on and so forth, how long we need to do the loan for, and all of that. There are closing fees, and what they allow us to do is put different things in place. For GCA members, they'll get a reduction in the percentage. Normal percentage will be 6.5% closing. GCA members will get a 5% closing fee. And each month there will be an admin fee to take care of all the payments that need to be made to vendors and subcontractors and the like. Typically there will be no personal guarantee, only if there are some extenuating circumstances where we require a personal guarantee. We will not use personal collateral. Again, the receivable is your collateral. Your contract is your collateral. Again, we prefer to get you pre-qualified. Once you get a contract, you can submit a full application. We'll go through the funding and the review of the contract and the design of the payment schedule and payments back on the loan during funding approval. And then we're just setting up closing. So it can be a quick process. And any questions? Anybody have any questions for me? They're going to get me because I went over 30 minutes, but you guys have my back, right?
Question.
Yes, sir.
So what kind of interest rates do you charge for mobilization funding?
Mobilization funding on average will cost about 5% per month with a minimum of 2 months.
And and you have only a max of paying that back in 4 months?
Yes,
Okay.
And then also the $200.
the $200 admin fee. Yeah.
So that admin fee, so like basically you'll be
Administering the
making
payments
all
and
the
things
payments,
like
so
that. Right,
we wouldn't have to deal with it.
exactly.
Oh, all right.
Any other questions?
How soon would you do the pre-qualification?
Whenever you're ready.
Oh, we contact you for that?
Yes.
Okay, I just want to make sure.
Can I say you the money, man? You the money.